Today, I'm going to show you 4 specific strategies that I have seen wealthy clients use over time as far as their charitable donations are concerned, not just purely out of generosity, but also for tax planning purposes for today, as well as leaving a legacy to their heirs tomorrow. Over the course of my career, I've had the pleasure of working with hundreds of families as they move through wealth transitions over time, and they tend to have a few tools in common. Using one's wealth for both purpose and with efficiency, which raises the question, why do some of these wealthy retirees give so much money away in the first place? I always like to give the benefit of the doubt, and I would say that the driving force in many of these instances comes from a place of generosity, caring, and the want to make change. But with that, we can't count out the fact that in many situations, it's also a deliberate planning strategy as well. Herein lies the key of what I've seen in having the opportunity to handle some of the challenges that could come along with building significant wealth. And instead of worrying solely about income in retirement, we tend to shift the focus to things like tax planning, estate planning reviews, and passing money to the next generation. And this is where giving in some instances can take on a whole new role. Not only do you have the ability to potentially make an impact for causes that are important to you, but you also could create a tax efficiency strategy over time. For example, every dollar shifted in some way or another is the potential dollar that doesn't get added to the federal estate tax limit when you do pass those assets to the next generation. That tax, in some cases, could end up being as high as 40%. So if you take the opportunity to move over, say, $500,000, that could end up being a savings of about $200,000 over time. Of course, it's important to keep in mind that these dollars would have to be above and beyond the federal and state exemption thresholds. When framed this way, giving can seem more of like a moral cause. Every dollar transitioned above and beyond those particular limits could end up being a dollar saved from erosion by taxes. Consider a hypothetical retiree that decides to make the choice to give money away in a substantial portion year over year. Not only are they supporting causes that might be important to them, which can include things like a hospital or a school system, or even a local foundation, but they're also shifting dollars away from their taxable estate, which could potentially get hit with taxes later on in life. Over time, this could end up allowing them to pass substantial money to their heirs, in addition to supporting causes that are important to them. These scenarios tend to be less about just casually writing checks and giving things away, and more so about a structured financial plan. And one of the tools that could be considered to help carry out this strategy is that of a donor-advised fund. Picture being able to lock in a tax deduction in a year that you really need it, but having time, potentially years or decades, to figure out which charities you want to support and allow them to benefit from your contribution. That's a function that a donor-advised fund can provide. Retirees might use this option to match unpredictable income years, where they're able to get a deduction and put money away, in addition to not having to rush and decide which charities they're going to give that money to later on. Let's say you experience a larger than normal income year, whether it's selling highly appreciated stock or even the sale of a business. Making a contribution to a donor-advised fund could allow you to capture that deduction immediately. It's important to note here that as far as tax rules are concerned, any money given to a donor-advised fund is irrevocable and cannot be taken back. At the same time, you do retain the ability to end up making the recommendation for where those funds should go. However, also important to note, the sponsoring organization of the donor-advised fund has the legal say in where the money ends up being contributed. Another potential advantage that I would take into consideration here is donating highly appreciated assets. Imagine purchasing a stock for $50,000 years ago, and it's now appreciated to a position of about $500,000. If you decide to sell it at this point, the entire $450,000 gain would be subject to tax. However, by transitioning that to something like a donor-advised fund, those capital gains end up being taken on in a tax-free manner when sold by the fund, and you are able to take the full deduction up front. It is worth noting, however, these deductions and contributions do come with limitations. Generally speaking, contributions made via cash are generally deductible on your adjusted gross income by up to 60%. But contributing long-term appreciated assets over time are deductible up to 30% of the value. Any unused deduction in the current year can be carried forward for up to 5 years, and this can be a meaningful impact on your overall planning if you think that you could have high-income years going forward. Being that everybody's situation is different, it could be useful to speak to your tax advisor for your particular plan. In addition to this, I do often find that folks that are philanthropically inclined do have several causes that are important to them. With that, by making that one contribution to the donor-advised fund, you can then use that as the sole source where that fund will then allow those distributions to go out to the multiple causes, as opposed to having to cut multiple checks yourself. This can consolidate record keeping for you and allow you to keep your books and records a lot more neat and clean. I will say, I've also seen the emotional importance of making these contributions over time. When you have situations where a parent or a grandparent might include their child or grandchild in deciding which grants should go to which foundations. With that, what could start off as a simple tax strategy could end up evolving into a way for your family to come together and understand how to steward wealth responsibly. Some quick caveats to be aware of. Again, there could be administrative costs which could differ based on the financial institution sponsoring the fund. In addition to that, remember that all contributions are made irrevocably. All things considered, donor-advised funds can certainly be one of the more versatile ways to balance your charitable giving in addition to your tax planning. But charitable planning doesn't just stop there. It's not always a situation where we encounter somebody having a higher than income year due to sale of highly appreciated stock or a business. It could be dealing with mandatory withdrawals from your retirement account, also known as required minimum distributions. This situation presents a very different planning opportunity, which also could cause for a completely different strategy. In the event you're unaware, a required minimum distribution is where a retiree reaches a certain age, for 2025, that age being 73 years old, and you are then forced to take a certain percentage of your pre-tax retirement accounts each year thereafter, whether you need the money or not. This is where a QCD, or Qualified Charitable Distribution, could come into play in your planning. A QCD allows IRA and pre-tax account owners to take a portion of their money after reaching the age of 70 and a half and distribute that to a qualifying charity. The distribution still counts towards satisfying their RMD for the year. However, it's not added to their gross income. In 2025, the QCD limit is $108,000 per IRA owner, or $216,000 per couple filing jointly. To see how this works in practice, imagine your RMD is $100,000 for the year, but you already have your living expenses covered by other sources of income. If you accept that $100,000 distribution directly, that now gets added to your income for the year and could end up increasing your tax bracket or other costs associated to your modified adjusted gross income. In contrast, by giving that $100,000 to a qualifying charity through a qualified charitable distribution, you're able to satisfy your RMD, but that income never hits you. Unlike ordinary charitable deductions, which only reduces income once that withdrawal is reported, the QCD takes that withdrawal away from your situation entirely. This lower AGI can potentially ripple across multiple pieces of your financial plan, whether it ends up resulting in something like less of a portion of your Social Security being taxed, maybe you receive lower Medicare premiums, or maybe you don't end up hitting the phase-out limits for certain state deductions. With that, there are limitations to keep in mind as well. QCDs need to be made as distributions directly to public charities. They cannot be made to donor-advised funds or private foundations, and it's very important to make sure you route this correctly, or it could end up eliminating the situation for yourself entirely. The IRS also specifies that you cannot receive anything in turn from making that QCD, so this must purely be a true donation. Because these requirements are strict, it could be worth your time to speak with your accountant, your advisor, and the custodian of your IRA or pre-tax account before making these choices and actual withdrawals. And while QCDs can seem as a streamlined approach for planning on an annual basis, sometimes greater levels of wealth require greater timelines in thinking, where we have to think about transitioning wealth in a multi-year process. And one way that retirees might do this is considering charitable trusts, a vehicle that can help balance your family needs and goals in addition to your charitable and philanthropic values. Two structures which I encounter most commonly are the Charitable Remainder Trust and the Charitable Lead Trust. Put simply, a Charitable Remainder Trust allows one to transfer assets into the trust. A structured system of payments or dividends is given from that trust to a specified beneficiary for a certain period of time, and the money that is left over and remains will then be given to charities of your decision. And a Charitable Lead Trust works in just the opposite way, where it allows you to transfer a sum of money. Structured payments over a set period of time are made to a qualifying charity, and any money left over at the end of that period is given to the beneficiaries of the trust. At first glance, this might seem complex, and you might think that trusts are only for the ultra-wealthy. And while these trusts might come with slightly larger expense as far as legal fees and administrative fees are concerned, they could end up being a better option if you're considering more than just a one-time donation. Let's take a look at how this works in practice. A retiree can choose to utilize something like a highly appreciated stock position or real estate. And instead of selling that in your own name and triggering capital gains tax, the sale can occur within the trust where the capital gains tax is tax-free. After doing so, not only can you reinvest the proceeds within the trust, you get an immediate deduction for the fair market value of the assets on the date the assets were transferred into the trust, and you can now create a stream of income, whether for yourself, a beneficiary, or charity, depending which trust structure you use, and then the money passes on after that remaining time is over. It's important to note that there are some caveats in choosing to go either of these routes. Number 1, potentially having the willingness to commit significant capital. Number 2, carefully drafting legal documents. Number 3, potential for additional administrative fees. And number 4, choosing a trustee for the trust. And while financial due diligence could be essential into making these decisions, it is important that you can't count out the generational impact that you could have in including those heirs and the ones that are closest to you in making these choices. Opting to intentionally build a legacy by design rather than by default. And if you're considering any of these strategies, it could be worth getting your entire team of trusted professionals together to have one consolidated conversation. And with that, if tax planning is part of your approach or something that you want to learn more about, check out our next video here.